Thank you for joining today. For those I haven't met before, my name is Bruce Kirsch. I'm the founder of Real Estate Financial Modeling, and my work over the past 2 decades has focused on analytical frameworks used by real estate investment professionals. Over the last several years, probably like many of you, I've been working with AI. I have also been part of a team developing an enterprise-grade software system that integrates artificial intelligence into underwriting workflows. The combination of those two experiences has made one shift increasingly clear. AI is beginning to change not only how analysis is produced, but how it must be evaluated before capital allocation decisions are made. That shift is the subject of today's discussion. What I want to discuss today is not AI as a software trend, not AI as a productivity tool. It's a more specific and increasingly important issue: how professionals evaluate AI-assisted analysis before that analysis influences capital allocation decisions. Across underwriting environments today, AI-assisted tools are becoming embedded in ordinary analytical workflows. Offering memoranda can be summarized, market information can be synthesized, investment memoranda can be drafted, sometimes in seconds. These capabilities are changing the speed and shape of analytical production, but they're also introducing a more consequential shift. Historically, analytical competence in underwriting was demonstrated primarily through the construction of analysis. As you know, analysts built models, structured assumptions, tested sensitivities, and defended their conclusions. In AI-assisted environments, a growing share of the work is at least partially machine-generated or machine-shaped. That means the professional task is no longer limited to producing the analysis. Increasingly, it includes evaluating analysis generated by AI systems before relying on it. That's the central idea of this session. The defining capability in AI-assisted underwriting is not simply using the tool, it's analytical judgment. More specifically, it's the ability to evaluate AI-assisted analysis before capital is committed. This is what I mean by AI decision readiness. Let me begin with a sentence that will sound very familiar to anyone who's participated in an underwriting review or an investment committee preparation. Based on the underwriting, the deal generates a 5% yield, 15% IRR, and a 1.6x multiple, so it appears to meet our returns thresholds. Most of you have probably heard some version of that sentence before, and it sounds perfectly reasonable. The numbers appear coherent. The returns appear to satisfy stated thresholds. The sentence itself has the tone of disciplined underwriting. Nothing in it sounds obviously careless or suspect. And that's exactly why it's useful. Because in practice, much of the analysis we rely on in underwriting environments arrives in this form. It's compact, it's apparently structured. It gives the impression that the reasoning has already been completed, and the only remaining question is whether we agree with the conclusion. It's ordinary, it's familiar, and it sounds credible. And that's why it's so important to examine what exactly sits behind it. Now, here's the important point. Every number in that sentence on the last slide could be correct, and the decision could still be wrong. That observation matters Because it forces a distinction between numerical correctness and decision correctness. The spreadsheet can calculate correctly, the return metrics can reconcile, the summary can accurately describe the output, and yet the investment conclusion can still be unsound. Why? Because the real analytical risk often sits far deeper than arithmetic. The assumptions may be fragile, the reasoning chain may contain gaps, the investment thesis may depend on conditions that were not properly stress tested. The analysis could fail to capture a hidden dependency, some sort of nonlinear exposure, or a structural shift in market conditions. In other words, the issue may not be whether the numbers were computed correctly. The issue may be whether the reasoning that produced those numbers has actually been validated. Most analytical failures in capital allocation are not dramatic spreadsheet errors. They're failures of evaluation. They occur when analysis appears persuasive before its reasoning has been tested with sufficient discipline. That's the problem space that we are dealing with today. Imagine that you're in an investment committee and the underwriting memo says the deal works. Before accepting that conclusion, what would you examine first? Would you begin with where the returns actually come from? How sensitive the outcome is to assumptions? Would you begin with whether the thesis itself is realistic? While we're showing these possibilities separately, most experienced professionals instinctively think the answer is all of the above. And that instinct tells us something important. It tells us that professional analytical judgment doesn't begin with acceptance of a conclusion. It begins with interrogation of the structure behind the conclusion. A serious reviewer wants to know what's driving the return, what assumptions are doing the work, how stable the conclusion is under different conditions, and whether the underlying thesis remains coherent once you stress the analysis. That evaluative instinct is not peripheral to underwriting, it's central to it. And in AI-assisted environments, it becomes even more central because the presence of a polished output increases the temptation to move prematurely from analysis to recommendation. And this is where something interesting begins to appear in organizations. What I think is happening now across analytical organizations is that two distinct patterns of behavior are beginning to emerge. On one side are professionals who primarily use AI to generate summaries, accept conclusions more readily, and move toward recommendations. And their work often appears efficient. The outputs are polished and the workflow is faster. On the other side are professionals who proactively evaluate AI-assisted analysis. They challenge the assumptions, they test the reasoning, they validate reliability, they calibrate confidence. Their work may not always look as fast on the surface, but it tends to earn more trust than that of the first group. That distinction is increasingly consequential. In many environments, the analysts trusted with decisions will be that second group, not because they resist technology and not because they refuse AI-assisted workflows, but because they understand that persuasive output is not the same thing as reliable analysis. And this is one of the most important professional differentiators now emerging. The market will reward not only those who can generate the AI outputs, but those who can explain how those outputs were evaluated before we decided to rely on them. That difference becomes very clear in one particular moment. This slide captures a moment where the issue is impossible to ignore. How did you validate the AI output before relying on it? Okay, that's the question. In many investment committee environments, professionals are not judged solely by whether they can present a conclusion. They're judged by whether they can defend the process by which the conclusion was reached. In AI-assisted workflows, that means being able to explain how machine-generated reasoning was tested, challenged, and validated before it was allowed to influence capital allocation. Those who can defend their evaluation process are the ones trusted with decisions. Trust in professional environments is not awarded simply because work appears efficient. It's awarded when reasoning can be defended under scrutiny. And this is where AI decision readiness becomes a real capability rather than an abstract concept. It's the discipline that allows a professional to answer the question credibly. And we can actually visualize where that discipline sits in the workflow. On the left, there's the AI output. On the right, the investment decision. Between those two sits a professional discipline: assumption validation, reasoning checks, reliability assessment, confidence calibration. This middle component is the crucial one. The point is not that the AI outputs are inherently unreliable. The point is that they are not self-validating. So there must be a disciplined process between output generation and decision reliance. That process is what determines whether the AI-assisted outputs deserve trust. Without that discipline, AI outputs move too quickly into decision making. With that discipline, professionals preserve the evaluative standards that have been in place and that capital allocation requires. Now, the good news is that underwriting already contains tools designed for that type of evaluation. Many of you are probably experienced analysts, and we all know that we rarely accept conclusions at face value. We test whether the reasoning behind the conclusion actually holds. So we do that typically through some form of sensitivity analysis coupled with scenario analysis, and sometimes we even take it all the way to Monte Carlo simulation. Okay, so these are the methods that we use for evaluating whether a conclusion deserves confidence. I want to make clear that AI does not eliminate the need for these methods. In fact, AI-assisted analysis often increases the importance of these methods. When outputs are generated faster, presented more cleanly, the temptation is to confuse speed and coherence with robustness. But the real question always remains the same. Do the conclusions actually hold? So AI decision readiness is not replacing professional analytical behavior. What it's doing is it's formalizing and extending the evaluative discipline that good professionals already understand. But to understand why this issue has become more important recently, it helps understand how AI systems actually generate outputs. Generative AI models produce outputs by predicting the most probable next word in a sequence based on patterns learned from very large data sets. The design of these systems makes them exceptionally good at producing plausible language, coherent explanations, and statistically likely sequences. But that's not the same thing as verified reasoning. This is the conceptual foundation for the risk that we're discussing. AI systems are optimized to produce outputs that feel complete, persuasive, and internally coherent. They are not inherently optimized to verify assumptions, validate intermediate reasoning steps, or ensure decision robustness under changing conditions. Recent large-scale analysis of real human AI interactions found that users who continued probing AI reasoning were substantially more likely to detect flaws and missing context, while many users reduced evaluation once the outputs appeared complete. The pattern is that persuasive completion reduces scrutiny, and that pattern is highly relevant in underwriting environments. So when we ask why AI outputs sound convincing, the answer is not mysterious. They're designed to sound like they have 100% confidence. And that's precisely why professionals need a rigorous evaluative discipline before relying on them. And that leads to a very important implication. A system can be trained on billions of documents. It can learn language patterns at extraordinary scale. It can generate token by token sequences that sound exactly like disciplined professional reasoning. And the result could be beautifully composed garbage, right? The age-old mantra of garbage in, garbage out certainly still applies in today's environment. So we all know that a persuasive explanation is not the same thing as a verified conclusion. A well-written memorandum is not the same thing as robust underwriting. A coherent narrative is not the same thing as tested reasoning. The inputs to these models are so vast, and the explanations are beautifully fluid, but our professional obligation remains the same. We need to determine whether the reasoning deserves trust before it touches capital. That's the evaluative burden that AI places on the analyst. Okay, when persuasive outputs are accepted too quickly, several predictable analytical risks appear. Most people, when they think about AI getting something wrong, will think about hallucination. The model just literally makes something up. And yes, it happens. But in underwriting and investment analysis context, hallucination is actually one of the easier failure modes to catch. The ones that cost you are much more subtle. Take hidden dependency, where an AI-generated rent projection looks entirely reasonable, but it's quietly resting on an absorption rate assumption that was never disclosed and doesn't apply to a particular submarket. The number isn't made up, it's just wrong for reasons that you can't see. Or take narrative bias, where the model frames a deal's risk profile in a way that's directionally accurate, but systematically tilts the conclusion and implies something that it shouldn't based on how the prompt was constructed and communicated to the AI. Now, these are not edge cases. They show up in real underwriting workflows. There are at least a dozen distinct failure modes, and we're not going to go through all of them here, but each one of these requires a different evaluative response. Now, we cover all of them with CRE specific examples in the preparation materials, in the certification, which I'll talk about in a little bit. The important point, though, is that these failure modes don't usually present as obvious mistakes. More often, they present with 100% confidence. They present as clarity, as analytical completeness, and that's what makes them dangerous. They're easy to accept precisely because they don't look like failure. So our job as the professional is to detect the hidden vulnerabilities before they become decision errors. So the next practical question becomes, what does a disciplined evaluation process actually look like? Here's the discipline framework that's the operational core of AI decision readiness. And this spans over 2 slides. So we're going to flip to the next one in a moment. First, we identify the key assumptions. In any underwriting conclusion, some assumptions are going to carry more of the analytical burden than others. We need to identify which inputs are truly driving the recommendation. Next, we test sensitivity. Once the key assumptions are identified, the question becomes, how dependent are results on them? If modest changes to these assumptions materially impact the outcome, our confidence should fall. Third, we examine analytical reasoning. Do the intermediate steps of the logic hold up? Does the logic connect the premise to the conclusion, or is it just plausible on the surface? Fourth, we stress the outcome. Do the conclusions remain plausible under different market conditions, under adverse cases, or altered structural assumptions? And then fifth, we calibrate confidence, right? Based on everything we've just reviewed, how reliable is the conclusion actually? And this final step matters because confidence itself becomes a decision input. Confidence, though, should be earned through evaluation and not borrowed from presentation quality. To understand why this capability is emerging now, it helps to look briefly at how the analytical stack has evolved. The underwriting stack evolved from manual work to spreadsheets to data infrastructure and now to AI-assisted analysis. And each stage changed what analytical work looked like. Manual spreadsheets made modeling portable, flexible. Data infrastructure increased the breadth and the speed of our information access. And AI-assisted analysis now changes the production of reasoning itself. And that last shift is the important one. When tools change how information is processed, professional standards eventually adapt. AI-assisted analysis is not simply another software layer. It changes the fundamental relationship between the analyst and the work product. When the reasoning can be partly machine-generated, the analyst's evaluative function becomes more explicit and even more important. And so that's why this discipline is emerging now. The technology has reached a point where evaluation is no longer implicit in production, and it must increasingly be made explicit. And that shift creates a new question for analytical organizations. The critical question is, how do senior leaders know analysts are evaluating AI-assisted analysis responsibly? How do they know? There's several possible approaches. Some firms might rely on informal oversight. Some may provide some form of training. Some may depend on a manual review process. And those are all reasonable, understandable responses. But there is another possibility, and that possibility is a standardized capability benchmark. Okay? The reason that idea matters is that organizational leaders increasingly need visibility. They need to know whether the AI-assisted workflows are strengthening analytical discipline or introducing new reasoning risks. And informal impressions are not always enough. As the workflows become more embedded, firms will increasingly want a more structured way to understand capability for evaluation across teams. That question matters because AI-assisted workflows are already embedded into our underwriting environments. For firms, this issue is not an abstract one. As AI becomes embedded in these workflows, organizations need visibility into how their analysts and associates validate these outputs, how they detect reasoning errors, how are they challenging automated conclusions that come to us in such speed that it's practically intoxicating. Okay, this matters because capital allocation processes are collective. Investment decisions don't depend on one isolated output. They depend on the cumulative integrity of the analytical work that feeds the committees, the recommendations, and the approvals. If evaluative discipline varies significantly across teams, then risk is not evenly distributed. Some conclusions may be properly stress tested, while others are accepted too quickly. In that sense, AI decision readiness becomes relevant not only for individuals, but for analytical governance. It offers us a way to think about whether evaluative discipline is consistent enough to deserve trust at the organizational level. One way to approach this problem is through capability measurement. Candidates can evaluate AI-assisted analytical outputs and demonstrate the ability to detect fragile reasoning, identify unrealistic assumptions, assess the reliability of conclusions, challenge automated summaries, and calibrate analytical confidence. This certification in AI decision readiness is not a software proficiency credential. It's not about prompt writing. It's not about familiarity with a particular large language model. It's about evaluating the outputs from those models in capital allocation contexts. The certification is intended to assess whether a professional can perform the evaluative work we've been discussing, right? It's an examination of judgment and not of interface fluency. So who is this actually designed for? The primary audience is pretty clear. Acquisitions analysts, investment analysts, underwriting analysts, associates preparing for promotion, portfolio managers, credit analysts, and really professionals of all stripe in real estate reviewing AI-assisted analysis, right? So the common thread is not the job title, it's the evaluative responsibility. Okay, if part of your role involves reviewing analytical conclusions that may be informed by AI-assisted workflows, then the capability being discussed right now is relevant to you. There's also an organizational perspective that's worth considering. Organizations can use certification results to understand how analysts evaluate AI-assisted analysis, how analytical judgment varies across their teams, and where evaluation discipline is strongest and where it's weakest. And this is important because the certification can function as more than an individual signal. It can also act as a benchmark for analytical judgment for your team. So for firms, the question is often not simply whether one analyst is capable. It's whether evaluative discipline is sufficiently distributed across the organization and across the teams to support reliable decision-making. Right? If some teams are consistently more disciplined in assumption validation, fragility recognition, or confidence calibration, well, that's useful information that relates directly to governance. So at the organizational level, the certification creates visibility. And at the individual level, it creates a way to demonstrate your evaluative capability. Now, historically, when analytical disciplines reach this stage, professional standards tend to follow. Financial analysis, right? Develop the CFA, accounting, develop the CPA, modeling, develop specialized certifications. Those standards emerged because industries needed a way to signal discipline capability once the work itself became important enough and widespread enough. The suggestion here is not that AI-assisted analytical judgment is identical to those disciplines. The point is really more modest, but more important. When new analytical capabilities become materially relevant to professional outcomes, standards tend to follow. Okay, so AI-assisted analytical judgment is now entering that zone as machine-assisted reasoning becomes embedded in workflows. A capability that once sat informally inside our professional judgment begins to look more like something that we can define, evaluate, and demonstrate. If evaluating AI-assisted analysis is becoming part of your role or is already part of your role, you should be able to demonstrate that capability. For those interested, the certification examination is currently open for early registration. It's available through March 30th. Early registrants will help establish the first certification registry. They'll also get access to the preparatory materials on March 31st and get access to the examination in the first examination window, which is in April. Let me leave you with one final observation. If evaluating AI-assisted analysis is becoming part of your work, you should be able to demonstrate that capability. Details are at the link shown here. Thank you again for joining today, and I'm happy to stay on for a few minutes. If there are questions, you can put them in the Q&A. Okay, so we have multiple queries which effectively ask whether this kind of evaluation discipline will become a formal expectation in analytical roles. That's an interesting question, and it relates directly to how professional standards tend to evolve when the analytical tools change. As AI-assisted analysis becomes more and more embedded in our workflows, the ability to evaluate that analysis responsibly may increasingly become part of what's considered professional competence. We have another question here, which is a good observation and an important question. And the point of the question is that experienced professionals are already challenging assumptions, and they're already testing reasoning. What does this certification add, right? In many ways, what we're describing here is what strong analysts already do, right? You already challenge assumptions and test reasoning and examine sensitivity and stress conclusions. So we're not, with this certification, introducing a new behavior. What the certification does is it makes this evaluative discipline explicit and measurable in environments where you're dealing with AI-assisted analysis. In some sense, the certification is less about teaching analysts what to do and more about making sure the evaluative discipline that good analysts already value remains visible as AI becomes embedded in our workflows. Thanks for joining, and feel free to reach out through the webpage if you want to schedule a quick consultation to figure out if this is right for you. Have a great day.